Hey, pack leaders. So, as you're working and building up your cash value in the life insurance policy, it's going to do very well and not have to, in a sense, deal with the ups and downs of the market that's manipulated by the Federal Reserve. And, when it comes crashing down or up or whatever it is, they're going to do whatever they can to pump up the market as much as they can and keep them. It's for our benefits, really. But the truth will come one day or another, and all that will be wiped out like overnight or half or something like that, which has happened in 2008. We're 2018 right now. It's about 10 years later. We'll see what happens in the next year or two. Cycles every 10 years, 12 years. So we're preparing and going from there. So when that happens, a lot of banks don't lend in 2008. So even though real estate is cheap, you can't buy real estate because there's no money and banks won't lend. If you had it in the stock market, it will kind of be stuck there unless you had cash sitting around. There might be a bank run. I don't know. So with the life insurance policy, now you kind of have to think what happens if it does crash. Does it all fall apart because it's all fiat, right? So I think there's a video that someone had posted about it, and it says, what happens if it does? Well, then if that does, then if it gets that bad, then it doesn't matter anyway. And what you really need is food and water. Okay, so you want to live in a place that has plenty of natural resources, plenty of water, plenty of life game that you can hunt and grow food. Okay, but you need water. Okay, most importantly. Okay, so if you got that taken care of, then I think you'll be all right. Okay, now let's say it doesn't happen that bad, and I think insurance companies have been around for over 150 years. It's been through a lot of 1929 Great Depression. It's been through a lot of other places, and it's still around. Okay, so with that, it'll just be hard to pull money out if the government's still there and just things are depressed. Okay, so with the life insurance policy, what they do is they don't fractional reserve lend. They lend to their own policyholders through the cash value. Okay, and the policyholders is what actually pays into back the 4.5% to the insurance company, and then as that makes money, you as a participating whole life insurance policy holder get the dividends from the interest earned from the life insurance policy company as a bank. Okay, so instead of giving all that money to the bank and they earn it and they fractional lend it and inflate the dollar like no other, it's a little more conservative over here where it's money done by um, the policyholders. Now, as far as the bank itself that the insurance company has, that does that bank itself do fractional lending? And I don't know. Okay, I probably do, but if the life insurance company is big enough and they can create their own bank, that would probably be smart. So then they can grow based on the insurance and not have to fractionally lend, but lend to its own policy holder. So it's just, I don't know how far you might have to research that. I leave that up to you. Just something to think about and consider. I haven't looked into it myself. I'm still new to all this stuff. I just kind of got a policy right to try it, and then this is what I've learned. I'm passing it down. Okay, so we'll see as I do update videos later on how well this policy has done for me, and then based on my success or my results, you can then view it from this first video into the later videos as I use the infinite banking system. Okay, now none of this was taught from my father, which is why I'm creating this, to pass this down to my children, because I wish I had someone to teach me this stuff and I have to figure it out on my own, which I'm figuring it out on my own right now, and you can learn from my mistakes. Okay, so if it totally bombs, you can just scratch this part, but this is what I'm passing down. Okay, alright, so what I'm going to be doing with that is to buy real estate when the market's down, once I have substantial enough of income. Now you usually have about 10 years per cycle, so you have a lot of time to just build it up. Okay, now in the meantime, while it hasn't crashed yet, we can invest in tax deed sales. They are basically property taxes that you can buy at auction at the courthouse. Cities have to collect property taxes, and their lien is actually higher than the mortgage, the first mortgage or the second mortgage, or any other liens below it. So if they auction it off, it clears out all the other liens. So if a mortgage company like Wells Fargo or whatever, Bank of America, has the first loan, they're not stupid enough to give up their position just because of a small amount of property tax is paid. So usually the bank will pay for that tax, foreclose on the owner, and then pay for it and take it over, right? So usually you get your interest back pretty much guaranteed because the bank's always going to pay, right? And if they don't, then you get the property. Okay. Now, different counties or states have different interest rates. Texas has a 25% fee. So even if they pay within 6 months, you still get the 25% off the deed that you paid. Okay. So if you're earning 4.5% on your money, on your cash value, but then you pull it out as a loan, you pay back 4.5% now. You use that 4.5% to make 12%, and then use that tax deed and then pay it back. Okay, so then you can kind of like take the loan out, put it into something like an asset that pays, and then pay it back into your bank so that you can grow a little faster. Okay, and any excesses that you have left over, it's your money. Okay, so that's how you can use money to make money, and then you have to find properties that you can invest and buy. Okay, if you get the property, flip it for more than you paid for, of course, and then pay the bank back, and then the rest is yours. So then as you grow this over time and build up the money manager's account, you can then own more policies, grow your bank a little bigger, and then you have, in a sense, a growing credit line that never goes away because of that compounding interest. Okay, so the only reason that we use the life insurance policy and start early is for the benefit of compound interest. Okay, and that's why we always take a loan off our principal that we put in and get the cash value out, which is the bank's money or the insurance company's money, so that our original investment will continually compound more and more over time. Okay, and even though we're paying back interest, and I'm like, why would I pay myself my interest for my own money, right? So it didn't make sense at first until it clicked, and you think about it, it's for the long term, because that $1,000 will come, or whatever it is that you kept building, continually compounds. So you borrow it and pay back, borrow it, pay back, and then when you need the money, you have to use it for as a good debt. You have to use it for assets that make money. Don't buy it to pay the car or go on vacation. I guess you could, because your cash flow does grow to a point where it's just there's so much that you can just use it. And if you don't pay it back, you take it off from the policy, the death benefit of what it's worth. So that's also a retirement fund, which is what I'll be used for my retirement fund too, because there'll be plenty of money there by the time I retire. Okay, so that's something that you need to start early and compound it and grow it over time, and always use the cash value and never the principal. And once that you die, then that total amount, death benefit, passes on to your child, tax free, and they get everything. Okay, but you get to pull out loans from it tax free also, which is also kind of a tax shelter ish kind of thing, because the loan is not taxed. Okay, but it's being paid for by the death benefit. Okay, just do it and learn from it, from experience. I didn't get it fully when I first started, but just do it and then learn it over time. Just pay the premiums. The first year will be like, where did it all go? But just make sure that you continue paying it, because after the second, third year, you'll start to see more cash value. I mean, your base premium, you won't see it, but the paid up additions is where you're gonna help it boost up a bit more. Okay. All right. So this is just a segue introduction on transitioning from the early part of building the wealth, and then how to then use that wealth to compound even more through tax deed investing. Okay, so we're gonna be moving to Texas in about 6 months, and once we all get settled in, I'm gonna start looking out, and then we'll do some more videos. Then I'll add on to this channel on tax deed investing and how it's performing for me. Okay, thank you for watching, and talk to you then.